Welcome to the Daily Update. This is Being Prepared Friday, October 7th, where we'll look at the action in the market today and then see how things look for Monday, October 10th. And first of all, the conference is going pretty well that I'm attending online. That's the difference for my posting schedule. And I'm possibly picking up a couple of good ideas that I may introduce to you at some point. And secondly, congratulations, Seattle Mariners. They won the first game of the playoffs in a best of three against Toronto. Who knows? They may not even win any more games at all, but at least they won the first game of the playoffs. So I personally, I'm kind of stoked about that. But looking at the market, we had a down day. The positive things that we were looking at, you can pretty much take those and throw them out the window, or at least set them on the back burner for right now. We have kind of a scary looking chart right now, which is often called an island reversal, and that could be pretty negative. And I'll show you that when I get to the charts. But the employment situation report came out and it was stronger than expected. It spooked the markets. Even though the report itself was not all that strong, it was enough to take this whole idea that maybe the Fed has topped with raising interest rates and will slow down, even though that's what they did in Australia. And even the UN came out and said, come on, Fed, slow down, quit raising interest rates. You're going to ruin everything. Well, the Fed's supposed to be independent politically and from all outside forces. Whether that's actually true or not is up to debate. But they're doing what they think is best, whether we agree or disagree with it. And so we have to go with that pretty much. And so that idea that maybe for the fifth time now, the scenario that rates have topped out and may start coming back down, that's been pretty much wiped out. So we'll just wait for the next one and see what develops as of that, when that happens at some point. So let's go back and talk about what did happen. We had a much lower gap open in Friday's session. We gapped below S1 at 37.23. We also gapped below S2 at 37.02. So we gave up the 3,700 level. As the day went on, prices kind of moved a little sideways to lower, just kind of incremental selling. They finally worked their way down to S3, which I usually don't have on the chart, but I did add to this one. And that was at 36.43, and they kept falling even below that. Going into the close, we did see a little bit of rebounding. Maybe it was some short positions that we had to buy to get out. We got back up to S3. So it was just not a very good day for the market at all. We were down 2.8% overall for the day. Volume was above average, and our technicals, they never switched over to being positive. There were some things that could be looking as a setup to take things more positive. Well, we kind of push those aside for right now as the market turns back a lot more negative right now. And it's because of inflation and interest rates, which are producing a lot of growth concerns, not only for you personally, but for companies, for the US economy, and it's also going global with all of this. Any one of the other concerns that we have, again, could always come to the forefront, specifically right now, Russia and the Russia-Ukraine situation. That could always escalate to the point where it has an influence on the markets. And then the Fed speak has pretty much been consistent with, no, we're going to keep raising rates until we feel that inflation is under control. No matter how many times the market comes up with a scenario that maybe we're going to stop doing this. So what are some comments that we can make? The employment situation report was stronger than expected. Not all that big, but it was enough to freak out everybody. Rising interest rates, because we had rates go up on Friday and the dollar went up. That's putting pressure on stocks. And this whole scenario that the inflation has topped. Now we're going to get another reading this week with the CPI, and that's going to be a really interesting day too. But inflation has topped, and so will the Fed. Maybe they'll stop raising interest rates. That seems to have failed yet again. So we'll just wait for the next one. In spite of this, because we had really strong up days on Monday and Tuesday at the beginning of the quarter, as new cash is deployed into the markets, and that gave a lot of support to stocks. even after the declines, we had a small decline on Wednesday, a bigger one over 1% on Thursday, and then a massive one, pretty big on Friday. We were still up 1.5% for the week overall. The Fed still remains pretty hawkish. I don't have any actual quotes, but they haven't changed that stance at all. We still have a number of yield curves that are inverted, and there's another interesting Isabel chart that I'll show you. Sorry, I had to clear my throat yet again. Sentiment, we're dripping down with the decline on Friday. We're back over into more the extreme fear category. And I'll talk about the employment situation report on the next slide. Another thing that's a little bit concerning, this isn't a major report, but just something to be aware of. Inventories are going up. They were up 1.3%. Last time I got this report, they were up 0.6%. And that just means things are sitting on company shelves. They're not going out and being sold. And that can also suggest more of a weakening of the economy. Our trend is negative. The ADX had been looking like it was starting to turn a little bit more positive. Well, with the down day, it's turning all right, but it's going back up negative. It's not quite across the moving average yet, but it is going back up. So it's getting stronger. The red line's on top, so it's negative, and we are above 20. And I'll show you that chart. Our bias is negative because of the down day. And I switched the momentum, even though we had powerful up days on Monday and Tuesday, Wednesday, Thursday, and Friday has switched the momentum over to negative. Let's look a little bit at the report that came out. Non-farm payrolls increased by 263,000. That was much greater than the 250,000 that they had expected. Non-farm private payrolls increased also more than expected at 288,000, where they expected 275. That's pretty much what the market used to freak out, because the other parts of the report, the average hourly earnings, yeah, they were up, but it was what was expected. The unemployment rate, which a lot of people don't really pay attention to because there's so much manipulation that goes into this, it actually dropped where they expected it to be 3.7. It came down to 3.5. The average hourly work week, it came in at 34 and a half hours as expected. Boy, wouldn't that be nice? Only having a 40 plus hours seems to be the norm. So let's go back and talk about what happened here. With the decline, fear is now back over, touching into the extreme negative camp. And you can see after coming back up, it's starting to go back down now. So we don't know if this is bottomed out yet, if there's still more room to go down. Here's a chart from Isabel. This just shows that energy relative to the S&P. Well, if you like energy, you might like this chart. It's suggesting here that we put in a head and shoulders bottom. And so Bank of America is predicting that energy prices are going to go up. And with all the debate and changes that are going on, the energy that we're currently using and that we need to have, yeah, it's going to become more precious. And then you have OPEC coming out saying that they're going to limit the amount of oil that they're releasing by 2 million barrels. So that has a tendency to produce energy prices to go up or help them go up. Another thing to look at, this is not a price chart. This is a volatility chart. And it just says it's higher in midterm election years, but then after October or after we, have the election and then it gets out of the way, this just shows in the average midterm year how volatility really starts to drop off. That could give some support to the markets as well. And then they compare it to a non-election year as well. Here's another one with the Fed funds annual rate of change. If there's one thing that's a little bit concerning, it's look how fast the Fed has been raising interest rates. And a lot of these changes from a few months back, 6 months back, they haven't even worked their way really into the economy yet to know what kind of influence this is going to have. And this goes back into the 1950s or so. But look at how far up we're at right now. It just means they are raising them very aggressively. Under Volcker, you had him just massively raising interest rates, but it didn't spike up as much as this. It did a little bit here, but look at how far out of line this is with historical norms. Also, and again, there's a little bit of lag with this chart. people were starting to bail out of the bearish mutual funds with the right X ratio here. Well, they probably wish now that they had stayed in them. This is probably reflecting Monday and Tuesday's strong up days. The active asset managers came out with their weekly survey. There's a little bit of a lag here. It did improve after going really extreme negative, which we often use as a contrary indicator. But all right, are they going to come back down since what has happened this week with the declines has happened? This is another one. Remember how we've been watching the 10 to the 3 month? It never has gone inverted. So what do? They kind of twist it around a little bit and say, okay, let's look at when the 10 to the 3 month is less than 0.25. It's still not inverted. It's still having a positive yield curve, but let's just go down and measure that part. And this just shows over time what has happened. And you can see how oftentimes this, when it gets to be this low, this is right before we see pretty solid declines in the market. So just something to be aware of. This is more negative slanting right now. Then in the euro area, GDP against current activity. This is just what are things going to look like in Europe going forward? Well, into 2022, they're still positive right here, but they are declining. They're projecting downward movements in 2023. These are just estimates right now, but they still have them. Actually, I guess I have to look over here on the right side. They still have them slightly positive, even though it is declining overall. So Europe is having a lot of problems. The UK is having problems, and the US is having problems. It's a global thing that's going on right now. Then the financials. According to Bank of America, they think financials are really going to go up from here. They think that this was a bear trap false breakdown, and then we've been going up ever since. So they see prices continuing to go up from here in the financial sector. Then, and I'm not quite sure what story count means. Is this the number of articles they count in publications? Is this the number of time? Do they do a Google search and count the results? I tried to look that up, and I'm not really sure what that is. But the light blue line here, this is the story count that there's going to be a recession. That has really spiked up. Well, oftentimes what happens during a recession, there's a large number of bankruptcies. And even though it is going up slightly, there's a pretty strong distance between these two where they have a tendency to stay more in line with each other and move in the same direction. So is the recession talk going to come down, or is the bankruptcy talk going to go up to get these lines more back closer to each other? Then the Challenger US job cut announcements. Well, we've been seeing this a little bit. It's starting to pick up slightly here. And I've been hearing some things here and there that companies are starting to lower some of their labor force. And you're not really hearing about it all that much. Well, this is suggesting that there's a little bit of a tick up in that, but it's not really going extreme. Not like during the COVID lockdowns where it's like everybody lost their job. And then we had a real spike up back during the financial crisis. It's not really rising that much currently. Looking at our sectors, look at this. Growth was down 3.58%, where value was only down 1.92%. Saw a lot of growth disintegration in the mid caps as well as in the small caps, but negative across the board. But we're not seeing necessarily a real spike up in the VIX, even though it went up and it closed up, but we haven't gone back to the previous highs, even when we were at right now what's considered to be prices that are just about the same as where we were at that time. Are we just waiting for that to catch up, or are we starting to see what potentially could be a positive divergence here? Then here's the VIX of the VIX with the down day. It's showing that the VIX did pick up a little bit. The Ulcer Index, which measures fear, it still continues to decline, even with the decline that we saw on Friday. We're down 24.47% from the all-time high. And see, this is what I'm talking about. See these three bars here? You could call this an island. And it looked like, okay, we're breaking out to the upside, but then everything just went down. They tend to call that an island reversal, which can, because these 3 days made an island. You see Gilligan and everybody there. And then to drop right down from that, that is a pretty negative thing to happen. But we're right back down into the areas where we were just about a week ago. Equity put call ratio with the down day, it did advance. And we're ticking back up slightly with our 5-period simple moving average, but we're still working off of this spike. Currently, I have posted these on the YouTube community tab on the YouTube channel, but here are the pivot points for Monday's session. We're coming right back down to these lows. This line that it was already here before, we broke above that, and now we're coming right back down to that level currently. If we fall below this, we might have a long ways to go before we run into any kind of significant support. At least on this chart, it would be clear down to the 3407 area for S1. And you can see how volume was above average. Here's the other chart that's posted on the community tab on the YouTube channel. And then some Fib charts. This is short term. This is going back to the August high, measuring down to what right now looked like it could have been the low. And we were looking at this because of overhead resistance. Well, we don't really have to worry about that now since we fell down. But are we going to break down below this and set an even lower low? There's another short-term chart showing how we're coming right back down to the June lows, and we're not exactly there, but we're getting pretty close to a full retracement again. Intermediate term also just a little bit right down here, kind of showing the same thing as the previous chart. We're kind of in no man's land with the longer term Fib chart. If we continue to fall, we're looking at about the 3510 area on this chart. And is this 200-week moving average going to provide support? We're coming back down again. We closed right down here last Friday and then massively bounced up off of that. What's going to happen if we continue to fall and break below this very, very long-term, very significant support? And then we'll probably, if we do, we'll probably come down here to this 50% retracement level, and things could turn kind of ugly. We'll just have to see over the weekend as people calm down a little bit. We'll see if we can get any more support of bouncing off of this moving average. We're coming down a little bit in our trend channel. We're kind of on the negative side of the midpoint currently. Looking at the sectors, every one of them was down with tech and discretionary communication, the 3 pretty weak areas. They were leading the way down. The one that was down the least was energy, and it was up for a lot of the day, but then it kind of gave up the ghost at the end of the day. We have the energy sector at the 98.9 scooter score for technical analysis. It's really the best looking chart right now. And we have communication at 8, and real estate has dropped down to 3. I'm still trying to figure out if these have negative scores. What happens when you get to 0? I don't know. All right. And then the energy sector is still showing, even though it was down a little bit, it's outperforming everything else. Utilities have just really hit a hard time, and that's giving some potential support to the S&P, but it hasn't followed through in price yet. And all the other sectors remain negative. Here's an update of how things have performed, going back to the all-time high that was set in the S&P. Seems like ancient history now. Technical alerts, most of them are negative. The S&P was below 3,700. That's the only one here. But the NASDAQ just ticking off 11,000, 10,9, 10,8, 10,7. Energy, which is again starting to show some improvement. It had a positive BPI going above 50, but all the other damage, that's the only sector. And then oil is back above 90 as we're seeing gas prices start to go up. And our scores, the mid caps are still holding up the best, even though they're not anything to brag about. Small caps are in second place, with the Dow in third place. The S&P's in fourth place, and the Qs are looking pretty sad right now. Here's our intraday chart. Right here's where we opened. We went below S1, S2, came down here. I had to draw in, and why did I put an R there? It should be S. Sorry, that should be S3. I guess I like that better. A little bit of hope. But we came right down to this level. It looked like maybe this was going to hold up, but we even dropped below that. However, we came right back up to this level when we closed. In our trend, this is showing how the ADX is turning back up with the red line going up and on top. So that is negative. We haven't crossed the moving average yet, but any more weakness or another day or two for this to recalculate, and we might see this cross. The Arun, no change. It's still suggesting that selling is decreasing as are buyers, but that's not really what's happening right now. Pretty negative day as far as breadth. We saw where we've been seeing some real up thrust days. Well, we saw a pretty significant down thrust day, both based on price and volume. So they are declining. Advanced decline ratio getting weaker. New highs, new lows. We saw a real expansion of new lows. So our 5 period is starting to roll over. It hasn't affected the 10-day yet, but if we see a follow through with this, that will likely happen. We're below the moving average with the accumulation distribution. So that is more negative. Short term, we may have overdone it. Going from Thursday to Friday, we really were down big time. And we also show this in the advanced decline ratio based on 1 day. We were pretty extreme. And this will probably be the last time I show a moving average chart for a while, because it looked like this might be providing resistance. Well, we've now broken down below the 20 period moving averages that we study here. Stochastic RSI is now turning back down. Williams percent R starting to get extreme negative. The force index is also really dropped. Swinland trading oscillator rolling over a little bit, but not necessarily as negative as you would think currently, but it's flattening out to slightly lower. McClellan oscillator dropped and is starting to get extreme negative. Saw a real disintegration in our 20, 50, and 200-day moving average study, starting to go back to extreme negative again. Stochastics, the short term, just went boom down. Intermediate terms rolling back over and looking more negative, and the long-term stochastic, which was trying to get out of extreme negative, it looks like it might be staying there for a while. Intermediate term rate of change going back 20 periods, we're starting to get extreme negative here. 50 periods just barely going into extreme negative territory. The Sean trend meter, extreme negative. The PMO, which was just getting ready to cross positive, well, it rolled over here, and it never did cross over based on price or volume, even though they got pretty close. The PMO study really showing a decrease in those PMOs that are rising, a small tick down with the buy signals. Hasn't really affected the PMOs above zero yet, but it most likely will. Chaikin oscillator showed some weakness and dropped below the midpoint, so that's negative. Also seeing weakness with the Chaikin money flow. And we're dropping off a little bit with our volume because it's not really going up all that much. The vortex went back up slightly with the selling, decrease with the buying, so it is negative. And our summation index, which was trying to turn up, has now moved lower and getting close to an extreme negative reading. The volume indicator, which sometimes can be a leading indicator, well, it got faked out a bit there. So it's starting to roll over as well. And let's see, the slope is positive. The MACD, which had just crossed positive, it's starting to roll over. The KST and the TRIX got close to crossing over, but never did. The PMO was very close, but didn't cross over. And the TSI, it did cross over positive, but is now starting to roll over again. The BPI didn't really go down as much as maybe you would think on such a down day, but it's because we're coming back to where we were not so long ago here. But this is negative since it never did get above 30. Ease of movement also showing weakness. Ultimate oscillator declining. Money flow index, after getting a very rare oversold reading, went back up, is now coming back down. Boom indicator, I thought this was going to go away for a while, but we're now back to extreme negative based on our 50 period moving average and declining based on the 200-day moving average. TTM squeeze, kind of confused overall right now. It doesn't really know what to do. Balance of power showing a decline. And after giving us this signal, which would have been a false signal, the CMB composite index is now coming back down. Our charts based on trend, we're starting to turn back negative with the hike in ASHI. We now have a black candle. We're still slightly positive with the KEGI, but the black line is going down. The Renko, which had switched positive yesterday, well, it's back to full-blown negative today. Three-line break after showing some improvement has now added a black candle. We added 3 new zeros to the point and figure, even though no signal has been generated, but zeros are never positive on a point and figure chart. We're back to negative with the Elder Impulse for the S&P and the SPY. But the SAR, the dots continue to be on the bottom, but this can really go a long way against you before it really goes, wait a minute, maybe I better switch and go the other way. So what I say is it can have big drawdowns. So this is a great indicator when we're trending. But when we're chopping all around, this indicator, since it doesn't change as much, can really get you on the wrong side pretty significantly. We're back to a deep purple signal now with the go no go system, and our long-term moving average study, which had been showing some improvement, is now starting to show more extreme weakness. Rate of change going back 200 periods, we're starting to be extreme negative again. The special K is still flattening out right now. And the diamonds are back to negative, and we dropped below the pivot point and are showing some weakness with the Dow. The Qs are back to negative and also further down below the pivot point. Currently, the VIXN, it was up, but not as much as you would necessarily expect on such a solid down day. And the NASDAQ also, after holding up around the pivot level, has now dropped back down. The mid caps, which were also holding up fairly well above the pivot, well, they closed below that. And the Wilshire, which closed slightly below the pivot, well, it's even more below the pivot after Friday's session. And this is kind of an interesting development. We were watching the Dow go down and setting a new 52-week low, as were the transports. And of course, they were down on Friday. Well, when this was happening, the utilities were still holding up, but now the utilities are just getting hammered, and now they're setting new 52-week lows, even where the trannies and the Dow is not doing that currently. Now, some people don't use utilities as part of Dow theory. I like to include it just because I think it tells more of a story. The dollar was up in Friday's session, and the correlation between the S&P 500 and the dollar still having a tendency to go in the opposite direction, but could be working its way more back to a neutral reading. Gold, which here we go, we're going to the moon, came right up to the 50-day moving average and has been declining. Silver, which broke through the 50-day moving average, it also declined in Friday's session. Oil is starting to creep back up. We're at 92.64 now. And the correlation between the S&P and oil, since oil is going up and the S&P is going down, this relationship is starting to get back down to more of a neutral reading, with still having a slight tendency to go in the same direction. Bonds, this is when I'm going to start including this chart. This is called the MOVE Index. This is the bond equivalent of the VIX for stocks. And this just, when the VIX is high, it's time to buy. When the VIX is low, it's time to go. Well, this just shows how the volatility, and this is as far back as I could get. I just did a Google search for this chart. It just shows how volatility in bonds has really been quite high, as bonds have been coming down, and the World Bond Index is also declining. Stock to bond correlation still having a kind of tendency to go in the same general direction. We still have the 10 to the 5 inverted, the 10 to the 2. Here's the 30 to the 5, which is inverted. And then this was the Isabel net chart, where instead of measuring it once it's gone inverted, they're saying, okay, what happens when it gets to 0.25? And the fact that we are so low could not be really positive for the market going forward. Tech to the 10-year, working up towards more of a neutral reading, even though it did tick down slightly. And this just shows how the rates have been going up, with the 2-year leading the way higher. But the 3-month was actually down slightly. Our scenarios, these are not in play right now, but I just wanted to update the charts. After showing some improvement based on price and volume with the 19-day average of the highs or the advanced decline ratio, we're getting back down to an extreme negative for both of these. Those above their 200-day moving average also had been showing some improvement. Well, it's given some of that back. The stocks above their 50 also starting to go back down, as they are with the mid caps and the small caps. The 10-day average of the highs minus lows it actually is improving still, because we never really saw the new highs, new lows kick into gear. So the big down day on Friday didn't affect this chart, and it actually showed some slight improvement. Then looking across the market at the 5-period moving average of the highs and lows, it's holding up a little bit better. And then we're still working off of this spike with the 5-period equity put call ratio, but again, that might be headed back up, and it possibly could set a new spike. Small caps, after holding up fairly well above the pivot level, dropped below that. So they still outperformed the S&P 500. So we're seeing a little bit of an improvement with this chart, but we're not seeing anything on the blue chart to confirm that. The S&P to the 10-year also getting a little bit more towards neutral, but it did tick down slightly. And here's our sector rotation, looking more negative with the Qs, discretionary and large cap growth against large cap value. And with the mid caps, even though they're above the moving average, showing some weakness. And the small caps, these last two areas, the mid caps and the small caps, they were looking more positive. Well, they're weakening in that area. And the S&P to the 2-year also having kind of a tendency to go in the opposite direction, but headed a little bit more towards neutral. And so we don't know if this is a spike or not, because the 2-year was up again. So we'll have to just wait and see if we top out with this and then start coming back down. This is one positive point, though, as utilities have just been getting hammered. Even though the S&P is down, it's been outperforming utilities. So this ratio continues to advance. And our staples were also down. And so this spike still looks okay, but we're not seeing any confirmation based on price movement yet. So, and this you can pretty much throw this out the window. After Tuesday's session, I was looking for a short-term pullback, slight pullback, not what we saw, after being overbought, and then possibly a confirmation of some other signals that we've been waiting to see what will happen. Not really happening right now. The mass index, and I'm going to take this off. This will be the last time I do this video until I see something like this again. This did not confirm anything positive. We're still having a positive cross here with the Copic curve. But now if this is crossing, this doesn't tell direction. Could this mean we're getting ready to go even lower than we are now? But that contradicts with this. We have the Pring bottom fisher. It has now generated a signal, and this is directional. So we'll have to see. But we have been led astray by this indicator before. It's not infallible. It doesn't pick up everything. It does help that we were down below this red line and giving in a signal, but we have to see follow through with price if this signals to be resurrected, so to speak. So what's our outlook for Monday? We're negative and possibly heading back to oversold. We're even there with a couple of our indicators. We don't have any economic reports coming out on Monday. We've got the whole list of geopolitical things that could happen, and I'm not including the Seattle Mariners in this list, but the big one is inflation and interest rates, and then anything that may come out that the Fed may say. Our scenarios, we're going down right now. The technicals are negative and could become oversold. They might have more room to fall. So we're looking much more negative currently, not looking pretty positive unless we do become oversold. And those few little positive areas that I pointed out, if they somehow come into play, So nothing really there. You might be able to go with the neutral because we're still below the moving average, but the ADX is starting to go back up. We're above 20 and negative. So it's hard to really do a directional type of strategy right now. So our conclusion, we are negative. Short-term negative could be becoming more oversold. Intermediate term negative, and long-term we are negative. So thank you. Have a wonderful weekend, and hopefully I will be all cheery because the Mariners won again in the best of three. If not, hey, it's been a great season anyway. And I will prepare the weekly video and the intermarket analysis video and post those as I am able.